Hey, 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 everybody. Welcome back. Yes, it is Wednesday again, and it is beautiful, and it is sunny, and it is Alistair, and it is Jeff, and it is the Real Deal Pod with both of us. And we are so happy to be back here with all of you for episode number 47. Holy, it's been a crazy start to the week already, and I don't think it's gonna stop just yet. Jeff, my man, how you feeling? You hanging on? You have been thrown off the wagon yet?
Nope, no, I'm hanging in there, enjoying this beautiful weather that we've transitioned into.
It's spring
Um,
already.
yeah, yeah.
It's beautiful.
Started a wild rose detox, so it's a 12-day detox to your, I think it's to your liver, and all you do is basically eat good stuff. You cut out the sugar, you cut out the bread. And me and my girlfriend are doing it together. So yeah, I'm on day three, and all is good so far.
Oh, that to me sounds awful, man. So do you have to drink like weird teas and stuff like that? Like weird cleansing teas and stuff? Is that where that
No,
desert rose, did you say it's called?
it's called the wild rose.
Wild rose. Now, why
I
is
think
it a
it's called the
wild
wild rose,
rose?
and
Now,
really what it is, it's four tablets or pills for breakfast and with your breakfast and with your dinner. And then you take a laxative when you go to bed 3 to 5 times a week, or yeah, within the week. And then you just really are cutting out your sugar, cutting
a
out your
laxative
cream.
when you go to bed, Jeff, isn't that counterintuitive to the sleep?
I don't question the process. I just do what I'm told. So yeah, it's called the
Okay,
wild rose. So day three, so far so good.
good. Good for you. Now, I asked this because I know a lot of people do this stuff. I don't. Do you do it because of drinking? See, I don't do it because I don't drink, right? So I eat healthy and stuff like that. So
Yeah.
I don't know. That's why I don't do this stuff.
I'm doing it just because I want to lose a little bit of weight, and I
Okay.
want to and they say detoxing your body is good. It's the first time that I've ever done it, and I've been motivated by my girlfriend. So I don't think if it was for her saying, "Hey, let's do this," probably Jeff wouldn't be doing it. But you know what? I'm in it, and I'm finishing it. So.
Well, good for her and good for you, Jeff. That is phenomenal. I can't wait to hear about how this thing ends up. I bet it's going to be awesome, but good for you, buddy. That's wicked.
We'll see. We'll see.
Sweet, man. Well, let's kick her off, I guess. I'm not even gonna I don't know if we're gonna touch on what has transpired over the past couple days. I'm gonna leave it alone unless what you want to talk about later has anything to do with it. For me, I'm not gonna touch on it because I'm in a wait and see mode. It's just a whole lot of chaos and anger and yelling and nonsense going on. So until these children kind of settle themselves and things sort of get sorted out, I don't think we can even speak intelligently on it just yet. So what my did you know for this week, Jeff, is did you know, Jeff, the February market stats came out and buyers are gaining leverage. Buyers are gaining leverage, Jeff. For the first time in 4 months, home sales in the Fraser Valley have increased as buyers take advantage of the growing inventory we were talking about
Right.
and softening prices, right? And so it has happened, right? We always say it. The more property, the more inventory that comes to market, the cheaper things get, right? Which is why it's so important, right? When inventory is at this level, right? It is important to start if your goal is to purchase, to start looking right now because as that inventory weakens and shortens, right? The prices start going up again.
Right.
So just to give us a sense of what we were looking at in February, we had 920 homes sold in February, which was actually a 13% from January. So go ahead.
And when you say 920 homes, that's within the Fraser Valley.
Just the Fraser Valley. I don't, like I said, I don't have Vancouver's market stats out. I actually want to have that for next week. But what normally happens, in all honesty, is we are very much the same now. In fact, the one that probably outpaces everybody, and it's really always due to affordability. We've talked about it before. Is Chilliwack. Chilliwack's always, typically seeing an increase because of the affordability out there, whereas the Fraser Valley and the Lower Mainland operate very much the same because it's becoming so balanced, right? In your price points. So we had, like I said, 920 homes were sold in January, which was up 13%, but we had 8,070 active listings, which was up 45% from last year and 55% above the 10-year seasonal average. So the 10-year, of course, 10-year seasonal average is the average homes that are listed at this time, at this season, the winter season. But that is crazy, Jeff. That's a lot of properties. And so the sales to active listings, right, was 11%. So that's properties sold to properties listed. And that effectively, that 11% tells us that we are in that buyer's market. So yeah, it's crazy. And prices. So single family homes were priced at about 1.5 million. Let's just round it up. It was actually $1,489,100. So we'll just round it up at $1.5 million. So we can, and this is where we talk about prices softening, but they're really being stable. It was up 0.5% from January and down 0.6% year over year.
Yeah. So
and then it's pretty balanced. It's pretty level, right? And then when you look at townhomes were $820,000. Again, right? They were down 0.7% from January, but actually they were down 2.1% year over year.
Okay.
Right? And then condos, same normal $533,000. Again, down 0.3% from January, but same as townhomes, down 2.4% year over year.
So a depreciating market.
Exactly. Yeah. And so with that being said, we were talking about it last week, things getting busier, right? We've seen properties selling a little bit faster with 39 days for detached homes, 36 days for condos, and 32 days for townhomes.
Yeah.
Right. So we're starting to see that is it that perfect storm going on, spring market, right? Uncertainty with what is going on in our economy and all that sort of stuff. It's going to be interesting again to see what these next additional few months carry out.
Yeah, it's interesting that you pointed out the depreciating market. I believe that we've now depreciated between that 2% mark for the last 2 years.
Yeah.
And unfortunately, even this week we were working on files with pre-sales that were purchased in 2022 that are now coming up for completion, and there are shortfalls from what they purchased it for to what the value is as of today. I worked with a file just yesterday. They purchased a 3-bedroom condo in Burnaby with GST, $1.65 million. Crazy that you're buying a condo for 1.65. Today's appraised value came, depending on the appraiser, was anywhere from 1.3 to 1.5.
Yeah.
So there was a shortfall, even on a best case scenario, of almost $145,000.
That's what I was going to say. When you told me the price, I was going to shout that that's worth 1.4 right now.
Yeah, and that's the thing, and this is kind of what gently reminded me about folks. If you guys are buying pre-sales, I believe property is still one of the best investments you can do. We're in the last couple of seasons where we've experienced depreciating markets, but typically our markets are increasing anywhere from 4 to 12%, depending on what's going on.
Yeah.
These last 2 years, not so much, but again, folks, if you are doing pre-sales, The key thing about pre-sales is understand that if you buy them for a certain amount and now they're worth less, you got to come up with the shortfall. That's what the bank lends on, is what the today's current value is,
Yeah. Yeah.
or the purchase value, whichever is greater kind of idea,
Yeah.
or lower, I should say. But more importantly, having the ability to complete on it. This client of ours, 1.6, I'm just going to say 1.65 just to keep it simple, $200,000 deposit down on it, could not come up with the funds to complete. Guess what's happening to her 200 grand?
Oh no, it's going away.
She's lost it. She can't
Losing it. Yeah, I know. It's just going
complete.
away. Oof.
So
That's tough. And so I just want to tag on to that, Jeff, because that is really rough. And that is the same thing when I'm speaking with clients that say they want to use pre-sales as an investment, right? And I say, okay, guys, but you have to understand what this looks like. And to your point, can you afford later on? What is the market going to look like, right? Is it better to buy this resale property, right, and know that what you can afford it now, and know that, right, you can withstand a depreciation or an appreciation? Or do you want to maybe gamble with, what normally is a pretty sound, right, thing to go with, but to your point right now, could end up backfiring on you?
yeah, yeah. I've been in this business well over a decade now. This is the second time that I've seen pre-sales actually being lower than what the current or higher than what the current value is, and
Right.
people either trying to find a way to complete it, or walking away from their deposits. And I've also been in the space where people are buying pre-sales for $1 million and now they're worth 1.3, right?
Yeah, exactly.
So again, where I come from is just based on this lady's unfortunate situation. Again, buying pre-sales is a good way of building your net worth if
Yeah.
everything statistically goes the way that it goes.
Yeah.
But again, it doesn't always go the way that it goes, but you have to be prepared to complete and cover that shortfall if there is one. And the crazy thing, what came out of this lady's mouth is, well, my realtor told me that if I wasn't able to complete it, I could just go and do private financing, but didn't
Oh.
really explain to her what happens if there is a shortfall. So explain to her, hey, if you have problems getting a mortgage, you could possibly go to private lending, but didn't really explain to her what happens if the market value is lower than what you bought it for, and what is your responsibility then. So again, it goes
Yeah.
back to what we've always been saying: surrounding yourself with a power team, surrounding yourself with professionals, and surrounding yourself with knowledge. Like even having this pod, if you can even reminisce 6 months, 7 months, 2 years down the road about, hey, this is what I
Yeah.
remember, what they said on the Real Deal pod. Again, you're taking that little bit of information and bringing it forward to educate yourself, right? So,
Exactly. Yeah.
yeah, a real unfortunate situation for this young lady. $200,000 gone.
Yeah, that's tough. That's tough. Well, I hope that her next investment works out better, and I'm sure she'll succeed, and this won't deter her too much, but it is a tough lesson learned.
Yeah,
Crazy,
definitely.
man. Crazy. So, Jeff, what you got for us today?
Well, you know what? What I want to talk to you guys about today is a little bit something about how much can you afford.
Well, that's
And
perfect because we just talked about the prices softening,
yeah, yeah. So this
right?
is what I wanted to jump in on. This was really to break things down into a way that everybody understands. So when you are trying to figure something out, ish, you're going to have a basic understanding on how to do it. And also to understand that if you are in the process of getting a pre-approval, really, you should have a good understanding, if you're working with a lending partner, really within 10 minutes of a conversation to see if you're able to do what you need to do. And if people aren't asking you, or if your lending partner or your bank or your broker is not asking you what we're going to be jumping into, then again, you might be not working with the best individual to getting the information that you need, right? So I know we weren't going to jump into this, but I got to jump into it. Donald Trump introduced his tariffs yesterday, March 4th.
Oh my God, that mouth breathing frittata. That he drives me.
So not to get too
ahead.
deep into that rabbit hole, but I was actually very, very impressed on our Prime Minister's response to it.
So was I. That's why you see this flag, Jeff. That's why you see this flag. I was so impressed. Go ahead.
Not a big Justin Trudeau fan, but you know what?
He brought it, baby. He brought it
yesterday, and I was very, very impressed with how he reacted to it. And I guess technically now we're going to be running into a trading war. And again, just wanted to touch base on what that's going to mean to our rates, right?
Right.
Going into a buyer's market, understanding what this tariff situation means to rates and what that could mean to the market, always really, really important, because everybody has a little bit of a different opinion on what this is going to do, right?
Yeah.
So understand that our next Bank of Canada meeting is coming March 12th. People are saying the overnight lending rate is going to drop 0.7%. Some people say it's going to drop 0.5%. I believe it's going to drop 0.25%.
Yeah.
But what we're going to see is we're going to see these tariffs being introduced. We're going to see retaliatory measures coming from the Canadian side. We're going to see fear into the stock market. You'll already see.
You already saw it. You already saw the markets this morning. Markets went bananas.
Take a look at your portfolios. They are down. What that means is people are taking their money out of the market. Yeah. They're sticking it into a safer investment, which are bond yields.
Gold.
Which are bond yields. And then what happens with your bond yields when this happens? You see fixed rates start to decline. We haven't seen that yet, but we are set to see it here within the near future. Yeah. Again, the tariffs, we talked about this last week. What that is going to do to our country is to either force it into a recession, or the media is going to put us into a recession. And then what that happens, that has an impact on our overnight lending rate and our prime rate, which also will dictate what our variable rates are going to do. So again, what we're seeing with this announcement of tariffs is we're going to see a rate environment that is going to start to decline. It's funny though.
Go ahead.
Funny though, I just got off a phone call with a business development manager for Manulife Bank, and he was kind of saying the opposite. He was saying, well, I don't know how rates are going to lower. And he had reasoning behind that. And in his opinion, his opinion was rates are going to drop, but in my opinion, they're going to rise back up as soon as the cost of goods come into effect, which has the effect on our inflation rate. But the one thing I also, where we got into a discussion, is that our COVID pandemic situation to our tariff situation isn't really a mirror of each other. They do have some similarities, but they're not a mirror to each other. So again, most economists out there believe that our variable rate is going to drop and continue to drop. And most economists out there are believing that our fixed rates are going to drop. So again, coming into a buyer's market, coming into lower rates, we've seen this before.
Right. And so that's what I would, exactly. And so just to quickly touch on that, on the real estate side as well. So what that could do, because what the tariffs are being placed on is steel and lumber. So that's going to have an effect on your pre-sales, right? So you're going to see construction costs rising. And of course, when tariffs are placed, it's placed on the businesses, and those costs and those burdens are then distributed out on us, the consumer. So with those rate drops happening, it may accelerate the resale market, right? And that is where you were saying that COVID and this are not a mirror. They are by no means, and I agree with you, like they're by no means a mirror. They're just similarities because the biggest difference between these two is COVID, there was relief given out.
Yeah.
In this, there will be no relief given out.
Yeah.
It's just rate drop without relief given.
Yeah.
Right? So that's why I believe we are going to see the rate drops happen because we are not also doling out money at the same time.
Yeah.
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 So
Yeah. In that time, I was saying to my network, Trudeau was handing out money like Black Friday and
yeah.
Boxing Day, right? So
Yeah.
that is a big difference
Yeah.
for sure.
Yeah.
So yeah,
Now,
but
if we are going to hand anybody any money, like I said, I am a proponent of giving businesses relief or companies incentives to build here, to start building up here, and to start manufacturing and building Canadian. Again, that builds our economy. That's a necessity. So that is responsible doling out of money, in my opinion. Sorry.
yeah,
Yeah.
providing it's done right, I think.
No. Yes, I don't want us to go back and help buddies and backhand deals and all that sort of stuff. It literally, we need to do it responsibly, and that's all that I've
Yeah,
always said. Yeah, it's
exactly,
responsibly. Yes.
exactly. Well, this is what I wanted to jump into. I wanted to jump into what we call discovery calls. I wanted to explain to our audience and remind you, Alistair, I know we talk about this all the time,
Yeah.
about doing how much can I afford? People will always come to me and say, well, and probably you even more so before they get to me is how much can I buy? Like, I want to buy this $1.3 million condo. Can I do it? And
Can I pause on that right there, Jeff? And that's
sure.
why I think this is so important because, like you just said, you think that people come to us and say, hey, what do you think? How much can I afford? Or like, what do you think I can do? That's actually very rarely do they. And we always, when we sit down and we do our own discovery calls with our client, and I do hope that other realtors do this, we do ask that question if they've sat down with somebody to get an understanding of what they can afford. And a lot of people get turned off by that, right? They just feel that a realtor is putting dollar signs to them, right? When that is actually not the case. Because every one of us can give you a story where we've taken out a client, shown them the most beautiful property. They have literally fallen in love and they've imagined their families growing in it and their grandchildren's coming over to play in it and write the offer and they're all excited. And then it comes down to financing and they didn't go and get pre-approved. And then all of a sudden they find out they couldn't afford it.
Yeah.
And they can only afford half as much.
Yeah.
Right? And so now you have to circle back, somehow recover from that devastation, and now go back and look at things that are going to be half as good as what you were dreaming you were going to be able to purchase. So my thing is to everybody out there, when you're sitting with a realtor, whether it be me, whether it be somebody else, and they're asking you that uncomfortable question for you, because it's just as uncomfortable for us, just so you know, right? Have you sat down with somebody? I don't use the word pre-approval because that is something that puts everybody's back up. But when we ask, have you sat down with somebody to have a discussion on what you should be looking at what price point you should be looking at? Please don't get upset, right? Don't get your back up. It's just part of us wanting to help you to the best of our ability. And then we can give you to Jeff because he's a master.
Yeah, and really what we do at that time is we get on a call and we're like, how much income do you earn? Right? So
Right.
this is where I want to go, folks, is that it really is this simple. When you are coming down to how much can you afford, we can really do this for you in an ish value within 10 minutes of a phone call, right? And to break it down really simple, and this is where I encourage people to take out their pens, especially if they're in the industry, be it on the real estate side, even if we have other lending partners that are listening to us, it really is this simple. And here's how it goes. Every $22,000 that you earn and pay tax on means you could borrow $100,000. Okay.
Yeah.
Every $600 payment you have takes away $100,000. So that could be a vehicle payment, that could be a loan payment, that could be any monthly payment that you have of $600 takes away $100,000. Every $14,000 of credit card debt or unsecured line of credit debt takes away $100,000. So let me just refresh it. It really is this simple. Every $22,000 that you earn and pay tax on means you could borrow $100,000. Every $600 payment you have takes away $100,000. And any debt that you have on a line of credit, unsecured, or a credit card of $14,000 takes away $100,000, right? And here's the cherry on top here, and then we're going to dig a little bit deeper into an example, is that on every $100,000 that you borrow, that's a mortgage payment of anywhere from $525 to $619.
Exactly. That's the affordability.
That's the affordability. On every $10,000 of that being borrowed, it's anywhere from $52 to $62 a month. So anybody that is out there and they're in the process of purchasing, and that seller comes back to you and says, I want $30,000 more than what you're offering, we have to break that down into what that $30,000 more means. And that $30,000 more means $150 to $180 more a month to your mortgage payment. And if you're able to do that, then you're able to increase that $30,000 purchase price if you choose to do so.
Right. And it allows you now to really break it down that do you really love this house and is it worth it? Can I afford that extra $52? Right? If you can, then yeah, it's probably worth it. But it also works the adverse when when the other realtor is coming back and they're saying, no, we want $30,000 more, and we're able to say, hey, look, it's just not in the cards because we already know from an affordability standpoint, it's not feasible, right? So it's a great number to know.
Yeah, and again, it's not very difficult. It really comes down to simple math, right? Yeah. The other thing that I wanted to jump into is when it comes down to how much you can afford. And I'm just going to keep this into the lane of banks, credit unions, and monoline lenders. Now, people are going to say, well, what is a monoline lender? A monoline lender is governed by the governing bodies of OSFI. It is a lender that basically its major investors are the big 6 banks of Canada and all the major insurance companies here in Canada, but they're only available to mortgage brokers. So when you are purchasing something, there's 3 lenders that a broker can go to. There's monoline lenders, and let's call it Home Trust or RFA or RMG or our First National, MCAP, are a couple to just kind of throw the names out there. So if you hear those names, those are monoline lenders. Then there's your banks and there's your credit unions. So when we are doing the financing or the application with them, there's always going to be something called the GDS and the TDS. It's the debt servicing, right? So if you've ever been in a loan situation and the lender or the bank is coming back to you and say, well, you're just not debt servicing, you need to have an understanding of what debt servicing means, right? Because a lot of people will just say debt servicing, they'll shake their head like they know what they're talking about, and then they walk away and like, what is debt servicing?
What did they just say?
What are they talking about? Right? So it's really important when it comes down to financing. It comes down to the money that you make. It comes down to the debt that you have. And then it comes down to how much of that income is going towards your housing costs, also known as the GDS. And how much of that income is going to your total debt costs, also known as the TDS.
TDS.
Okay. So your housing costs, just so you understand, are your mortgage payments, your property taxes, your heating costs, your strata fees. Your total debt cost, or your TDS, is all of that and every other debt that you have: student loans, credit cards, vehicle loans. And here's the thing where your credit becomes very, very important. I've said this before, and I will always say your income, your credit is as equally as important as your income, right? So if you have a credit score of 680 or higher, your GDS can be at 39%, which means 39% of your income can go towards the housing costs. If your credit score is 680 or higher, 44% of your income can go to your total debt costs. Okay, so that's your housing costs plus your credit cards, your vehicle loans, and student loans. And if your credit score is less than 680, then basically your GDS, which is your housing costs, only 35% of your income can go there. And then 42% of the income can go to your total debt costs, your TDS. And that's keeping it really simple. There's always exceptions to that. There's always kind of things that you can take a look at. But again, depending on your credit score, if your income or your GDS and your TDS falls outside of up to 39% of the GDS, depending on your credit score, falls outside of up to 44% of your credit score, then you're not going to qualify because of debt servicing. Does that make sense?
Makes sense to me.
So to keep it really simple, it's the income that you earn to the debts that you have, which, depending on your credit score, the percentage that is allowed to go to each.
Yeah. So here's a question, and this is actually the number that I've always kind of used as my average. I've just always used 30%.
30%, sorry, you're
30% for debt servicing.
Come again. Explain.
Like that is when it comes to like what amount you can be debt serviced at.
Oh.
I've always used the average of 30%.
Yeah, that would be a very conservative average.
I know. Right? That's the one I've always used. That's what I mean, because I'm a conservative person, but that's just what I'm saying. Like whenever I've spoken with or dealt with my own debt servicing, I've always just utilized 30% as my.
So remember though, your debt servicing for your housing costs is 35 to 39.
30.
If you're using 30, you're being conservative. Keep in mind your debt servicing for your total
debt service
is 42 to 44. So if you're using 30, you're being
very conservative. Exactly. Right? Either way, I know.
So the other thing that I wanted to kind of touch on too is basically the down payment and how much you need to have, right? So again, we've talked about this in previous pods. The down payment rules have changed.
Okay, can you pause? And is that why? Because the cost of living has grown. So I know you looked at me like I was crazy at 70-30, because to me that's what it is. So you keep 70% of your money and you debt service the other 30. That's why I've said I've always used that average, right? Now, and so it's always worked well for me, but I'm also older and that's been able to live my life through that number. Is that now because of the cost of living? Because I know you looked at like I was crazy, like, oh, so you're telling people the wrong thing. I'm just that's what I'm saying. I'm using the number that I've used my entire life.
Yeah.
So I'm saying, is it because of the cost of living changes and stuff like that, that's where that number, because I was taught, or maybe that was a Manitoba thing, but that's sort of what I was taught growing up.
Yeah, you know what? The GDS and TDS really hasn't changed for well over the amount of time that I've been in this business.
Okay, yeah. So that's interesting.
The GDS and TDS has always remained the same. It hasn't increased or decreased. Now, again, when I go back to debt servicing, there are some lenders that will allow the GDS, again, your housing cost, to be 50% of your income. Mm-hmm. There are some lenders out there that take a look at your total debt cost, which allows it to be 50% of your income. So there are exceptions to that, but it all depends on credit score, depends on savings, depends on overall net worth. But I don't want to get overly complicated and go into that direction, because if we want to keep this into the sandbox, Debt servicing, depending on your credit score, right? 39% can be used for housing costs up to, and then up to 44% can be used for total debt costs, your TDS, right?
Yeah, everything else. Yeah.
Yes, there are exceptions to that, but that's another day and another pod.
Huh.
Down payment, again, what I wanted to talk about down payment is understand that, and we've talked about this too before, Alistair, is you can be buying your sixth house. Providing that you are living in it, you can put down as little as 5% down, depending on what that purchase price is, right? Many of us, realtors, brokers, lending partners, social media, have relayed the message that, hey, you can only put 5% down if you're a first-time home buyer.
Yeah.
Right?
Yeah.
It is absolutely false. As long as you're living in it and or it's a second home, you can put down as little as 5% depending on what that purchase price is. Right? So keep in mind, though, that there is a sliding scale on the down payment. It's 5% of your first 500,000, 10% of the remainder. Another piece of information that gets a little bit confusing is that people think I can put 5% down on, let's use $600,000 as an example. 5% of 600 is 30 grand.
Yeah. Yeah.
The rule is actually 5% of the first 500,000, 10% on the remainder. So if we're using a purchase price of 600 grand, 5% of the first 500 is 25,000, 10% on the remainder, which is 100, is another 10 grand. So you would need to put a minimum down payment of $35,000 on a $600,000 purchase. So remember, if you're living in it, it could be your first house or your 10th house, you can put down 5% of the first 500,000, 10% on the remainder, and as soon as that property becomes one penny over 1.5 million, it's an automatic 20%. Right?
Yep.
So that is your down payment requirement. Easy?
Easy for me. I think it's easy for everybody else. I just, like, again, to your point, just make sure you don't get steered wrong by misinformation. And I like that, and I like the fact that you clarified for people, because that is the biggest one, is, oh, you have to put 20% down anytime after you bought a house once.
Right.
Right? Like, that's crazy. Even if you bought in a, like, even, and to the point where if you bought in a house and then sold it and then not bought in a house for what length of time was it? 6 years?
4 years.
4 years, I beg your pardon, right? You qualify once again to be able to put less than 20% down. So there's all those misnomers that people give when you say, nope, if you bought a house once.
Well, here's another one, Alistair. You can actually own a house, rent it out. You're renting that house that you own out, and now you're, say, renting another house for a period of 4 years. You also now requalify as a first-time home buyer.
Really?
Yes.
That's crazy. See?
So this is where I go back to always working with a working professional that understands and is current in mortgage rules.
Exactly.
Right?
Yeah.
Jim Rohn, one of the things, Jim Rohn is a well-known public figure, business coach. One of the things that has been challenged to me is listen to Jim Rohn or somebody that you totally respect for 30 minutes a day for a month. And in doing that, what that does, it just educates you and redevelops your mind into basically being a little bit more active and a little bit more current.
Yeah.
And one of the things that he says is you always have to be open to learning. You have to be an open book to new information.
Yeah.
You have to basically know what's going on within your industry, especially if it's always evolving. Mm-hmm. And again, I can bet my left pinky that if you go to 10 people and say, hey, I own a house, I've been renting it out for 4 years. I'm also been renting a property for 4 years. Am I qualified as a first-time home buyer?
I'm telling you, everybody's eyes will look at you glazed over and go, No,
Right.
I'm telling you there because yes, that like that to you that whole scenario just seems like a hard no, right? Unless you're dealing with somebody that's actually educated. And that's why we always say it's about the power team, right? About making sure you surround yourself with the best people.
Right.
Yeah.
You know, the other thing too, people will always say is, I want to put 20% down because I don't want to pay the insurance premium, right? Which is totally valid. And if you're able to do it 100%. But one thing I wanted to say is that if you don't have 20% down, and you have if you don't have 20% down, folks, there is an insurance premium that's going to be part of that mortgage, either through CMHC or Sagan or Canada Guarantee. But let's keep it simple. CMHC is going to charge a insurance premium for the mortgage amount if there's less than 20% down. But keep in mind that insurance premium is going to become part of your mortgage. Some people believe that they're going to have to pay that out of pocket, which is not the case, right? So where I want to keep this is that if you put down less than 20%, there is an insurance premium, and that insurance premium becomes part of the mortgage, right? So I've talked to a lot of people and they hold off from purchasing because they want to save up that 20% because they don't want to pay that insurance premium because they believe that they have to pay that out of pocket. Right?
Yeah.
Which is not the case. It becomes part of the mortgage.
Right.
So here's where I want to leave off. I want to give an example.
Okay.
So remember, how much income do you need to earn to borrow $100,000?
$22,000, Jeff.
How much debt per month, or what is your monthly debt payment that takes away $100,000?
$600, Jeff.
And if I have $14,000 in a line of credit or an unsecured line of credit, what does that take away from my purchase power?
$100,000, Jeff.
Okay, so let's go with this. We have an annual combined income of a teacher and a nurse of $150,000. So this is how simple it goes. Every $22,000 means you could borrow 100. So if we're at 150, 22, 1, 2, 3, 4, 5, 6. That's about $700,000 that person can borrow based on the income.
Yeah.
Now, if they have a car loan of $600 a month, we now know that 100,000 gets taken away.
Now there's 600.
Now you have 600, and now you have a down payment of 80,000. Now that 600 plus your down payment of 80,000 means you have a purchase price of $680,000.
80,000. Yes.
Right? It's that simple. Asking the right questions. How much do you make? What are your debts? How much do you have for a down payment? Equals your purchase price. And that, folks, can be done within 10 minutes of a conversation. So if you are waiting on any lending partner telling you how much you can afford, and I've seen people wait for weeks. It just drives me insane.
It's crazy. I know. It's crazy.
Right? If that is you or anybody that you know, it is less than 10 minutes to get an ish value of what you're able to afford. And that's what I got. That's where I want to leave it.
That's awesome.
Just to remind people that finding out how much you can afford is how much do you make? Every $22,000 that you earn and pay tax on means you can borrow 100. What are your debts? Every $600 payment you have takes away 100. Every $14,000 of line of credit debt, unsecured, or credit card debt takes away 100. Add in your down payment, gives you your purchase price.
Easy peasy lemon squeezy.
That's it.
I don't know where that came from, but wow. That's awesome, man. Like it, and that is like it is that easy. You shouldn't have to wait. And if people are making you wait for that answer, it just shows you that you're not of importance to them. So they should not be of importance to you. Because
or they don't know the
or they don't know the answer, which is even worse.
Yeah,
which is even worse.
And I also want to kind of, understand that those numbers do change, right? If the interest rates rise, those numbers shift. If the interest rates lower, those numbers shift. So it's not a dead on what you can afford. It's an ish value, and if it's within the range that you are wanting to buy, that's when you do online. That's when you do applications and documents to really sharpen the pencil.
And that's exactly it. It's a guideline, but at least you have a ballpark figure of what you can be looking at, as opposed to walking in blind and then, like we were saying earlier, falling in love with this perfect home and then coming to find later on that you have no means to be able to afford it and then have to start back at square one.
Yeah.
Right? So, yeah, man. Well,
and
go ahead. Oh,
folks, if you're buying something, get pre-approved. Right?
Yes, and that's what I was going to say. Yes.
Back to my story with this lady that bought this pre-sale in 2022, losing $200,000. The crazy thing is she didn't even get pre-approved for that purchase price of 1.65. So even if all the apples lined up for her, she was only approved for 1.1. So she, again, like, let's paint the different story. That property is still valued at 1.65. She put $200,000 down. She needs a mortgage for 1.45. When it came down for her to get financing, she was only approved for 1.1. So again, she wouldn't have been able to do it.
Jeff, you didn't even mention at the beginning that she didn't even get pre-approved. That is crazy. That's nuts. So again, it right there, it goes right back to the point that I made at the beginning. When us as realtors are having that discussion with you guys of, have you sat down with somebody to discuss what you can afford? We are not trying to be jerks. We are not trying to put dollar signs to you. It is the best way for us to help you, and it is the best way for you to keep yourself out of losing $200,000 like that lady just did. That's crazy. That's a story for decades.
Yeah. Yeah, wow. It's sad. It really is sad.
That is sad. Well, with that being said, I am going to end it on a happy note. I want to wish my amazing mother, Leslie Carrington. Yes, that's right. It is her birthday on March the 8th. She is an amazing woman, and she gave birth to this amazing guy. So I just wanted to make sure I give her a special shout out. But we want to thank you, as always, for joining us today. We want you to keep loving us, liking us, sharing us, telling everybody you know about us. We want to make sure that you guys are getting the most valuable information. We said it before. We said it at the beginning of this year. We have doubled down in 2025 and driving and delivering you guys the most valuable content we can. And man, with the environment we're in, that's just putting more and more work on Jeff and I's plate, because things are constantly changing. So with that being said, stay empowered, stay informed, and most importantly, Jeff,
stay tuned.
That's right. Stay tuned, folks. We'll see you next week. Peace out.
Y'all have a nice day.